Hello, and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm Jerry Hammel. In today's episode, we will dive into international tax provisions in light of expected new tax law. Joining us today on Let's Talk Tax is Greg Lambrecht and Jason Rauhe. Welcome, Greg and Jason.
Thank you.
Thanks, Jerry. Good to be here.
Yeah. Well, I've been looking forward to sitting down with you guys and having this conversation. Because when I look at the discussion on the potential new tax laws and things that have been talked, things that were discussed on the campaign trail, not a lot has been talked about with C corporations, regular corporations. And so I'm really interested today in talking about that potential impact with this new tax law. And if we go back to TCJA, that was a pretty significant change in the corporate tax landscape. Can you guys just share a little bit with our listeners about what were some of the major provisions that impacted corporations with TCJA?
Yeah, sure. So I would say TCJA was the nuclear bomb into the international tax world, for sure. And if I look back and think about that, I would say there was four major things that really stand out in my mind. First of all, obviously, was the transition tax, Section 965, that required all offshore controlled foreign corporations to have a deemed dividend of all their accumulated earnings that had not been previously taxed. The second two things are kind of, one was the carrot, one was the stick, GILTI and FDII. GILTI's the stick, and FDII was the carrot to do more exporting. And then the final thing that I think was very material was Section 245 Cap A, which allows offshore controlled foreign corporations to bring money back to the United States without the U.S. corporation having a tax impact on that.
Okay. And I did talk about C corporations, but Jason, it wasn't just, that impact wasn't just limited to regular corporations, was it?
Correct. It was to all U.S. taxpayers, and everything Greg ran over, except for FDII, still applies to U.S. taxpayers. So it's something that we really need to keep track of, even as we talk to our clients that have closely held businesses.
Okay. Well, I don't want to turn it into an hour CPE session, but I would like to just talk a little bit about the landscape maybe before TCJA in each of these areas, and then the change in TCJA and why it was a nuclear bomb that hit the tax world. So, and then we'll have a little fun and just talk speculatively a little bit about if corporate tax rates decrease or if they increase. What are some things that run through your mind in each of those areas? So I don't know, Greg, do you want to go first?
Well, yeah, I think if I were to break this down, I would break it down. I would, put 965 and 245 Cap A together, and maybe I can chat a little bit about that. And then I would think GILTI and FDII would go together, and Jason, maybe you can talk about that.
Yep.
So 965, the transition tax or mandatory repatriation tax, there was a one-time inclusion. It was mandatory for all previously untaxed earnings, meaning if you had earnings and it was not otherwise taxed under some other provision and you had not sent it back to the U.S., it was deemed to be a dividend, and it created a giant pool for most companies of something we call PTEP, and PTEP is previously taxed earnings and profits. It allows a corporation to then bring those earnings back, and it's not subject to taxation again in the United States.
So, Greg, let me ask, as I understand that then, so if I have a foreign subsidiary that I own 100% of, and it's doing very well, making profit.
Yes.
Prior to TCJA, I was only taxed on that on my U.S. parent if I actually received a distribution back of those profits?
I'll say generally speaking, yes, unless it was certain tainted kinds of income. But generally, if you're a manufacturer and you're accumulating tons of profit offshore in let's say Europe, normally tax jurisdiction, yes, you'd be able to defer that permanently.
Wow. Okay.
Yeah. Yeah. And so what TCJA did was on a one-time basis said, no, we're going to require that you treat all that as if it were a dividend. And there was some favorable provisions as far as tax rates and the ability to use foreign tax credits that allowed U.S. companies to even though they had this deemed dividend, really many of them didn't have a net tax, if I could say it, cash tax.
Mm-hmm.
And then that created what I'll call it a repatriation valve. So they have this giant pool of cash offshore that they now can bring back kind of when they want to in many cases without any tax impact. So the second provision that was kind of tied to 965 would be 245 Cap A, which in the scenario you described, Jerry, where you have 100% owned foreign corporation owned by a U.S. company, if you have continuing earnings like I spoke about, they're able to bring those back and receive a deduction for it now. So even if there isn't previously taxed earnings and profits, U.S. companies are able to bring that cash back to the United States in most cases and not have any further tax implications. So I think those two things allowed U.S. companies, many of them wanted to bring cash back to the United States, but it was punitive in many cases. This really eliminated that.
So those two changes really forced their hand in that they
Yeah.
had, it was deemed, which means they didn't distribute cash back necessarily.
Correct.
But basically it was reset at the end of 2017.
That's a great
And-
way to put it.
And
I
you
agree.
were taxed on that. So now there's actually, if that's the case, now there's actually an incentive to bring the money back
Sure.
in the U.S. and make investments in the U.S.
Correct.
Okay, interesting. All right, Jason.
And then kind of building onto that, going forward, then we have the GILTI, which is Global Intangible Low Taxed Income. It's a totally different way to calculate tax impact on foreign earnings. So like we discussed previously, if you had earnings that were outside the U.S., they weren't taxed. GILTI now taxes those, subject to certain limitations. And then there's a deemed intangible return and some other calculations, but essentially that now your earnings are taxed primarily in the U.S. on a going forward basis. And then anything that's not is under 245 Cap A, brought back tax-free. And so that's really kind of changing the game for most if not all, companies or U.S. taxpayers in general that have foreign subsidiaries. And then to incentivize local or U.S.-based manufacturing, they had FDII, Foreign Derived Intangible Income. And that's a deduction that you get. The reason we tie two of these together is there's some provisions within TCJA that sunset that change some of the mechanics that increase kind of the effective rate of these taxes at the end of the day, or these deductions at the end of the day. And so that's really something we're keeping an eye on, of how could that be impacted as we go forward. But we're not sure whether or not the entire game is going to change like it did in 2017, but we still want to be mindful of potential changes to that, as we can talk about as we go forward here.
Okay, so both FDII and GILTI reset at the same time at the end of
Right.
2017.
Yep.
And what you're saying is that there are some specific provisions in there that are scheduled to sunset.
Correct.
Even though maybe this new law is permanent, there are some pieces of it, and maybe you can get into that a little
Sure.
bit. I don't know, are those deductions or exemptions, or what like how does that sunset
so
work,
I can
and in
give
what
you
areas?
an example in GILTI. So for corporations, there's a 50% deduction right now of your GILTI inclusion. So the effective tax rate is 10.5%. That deduction on 2016 and forward drops down to 37.5%. So your effective rate goes up to 13.125. So it's a little bit different way to calculate. So it doesn't disappear, it just changes a bit. And that's an example of what's built into TCJA.
Okay, well that's interesting. You mentioned that for corporations. So is there something implied there, like if I'm an individual and I own part of a foreign corporation, could I also need to be aware of the GILTI regime?
Yes, you do. At the GILTI regime, there's a bunch of nuances as far as these deductions we're talking about. Section 250, for example, doesn't apply to individuals unless you make some elections. So it's a really, prior to TCJA, planning was relatively straightforward. Afterwards, even for individually owned foreign companies, it still is a complicated, detailed exercise of modeling and making sure you understand the final tax impact and not go based on what you read or based on what your friend says or whatever, because circumstances can change the end result.
Sure. Okay.
Yeah. And for FDII as well, there's a sunsetting provision. It's not completely eliminated, but the deduction that you would otherwise receive for FDII for exporting will be reduced, and that will increase the effective rate as well.
Okay.
Similar concept.
So both December 31st of 2025 is when they're currently in the provisions. If there's no changes, they won't sunset completely, but they'll have a change.
Okay.
Yeah.
So they'll still be around. It's just there's going to be some modifications in
Less
how
favorable.
they're computed.
Yeah.
Yeah.
Less
Okay.
favorable.
Right.
It's really interesting because I really haven't heard, on the campaign trail, and I know these are technical tax areas, right?
Right.
And not real exciting, and maybe they don't impact a lot of people, voters specifically. but you really don't hear a lot about that. And I've not heard many proposals on fixing some of these sunsetting provisions. That's why I was asking you about those.
Yeah. I mean, I think obviously we're just kind of scratching the surface on the complexity, but I don't think anybody could ever really speak about this campaign trail. It would have been a difficult conversation.
It would have been.
Yeah.
That's completely fair.
For sure, yeah.
Not really newsworthy, right?
Yeah. Yep.
Yeah. So, well, Greg, let's circle back on 965 and 245
Sure.
Cap A, and let's just make believe here for a minute that I know Trump has pushed a little bit for corporate tax rate reduction. And I think they've talked about 15%, if I recall. So we'd go from 21% down to 15. Let's say somehow that happens. What are some things? And I know you're not recommending to do anything today, right, until it's known. But if the corporate rates do go down, what are some things with 965 and 245 Cap A that immediately come to mind that taxpayers should be aware of, or at least take a look at?
Sure. Well, I would say with those two provisions, those are rate neutral because 965, you've already paid your tax, and you're able to bring those previously taxed earnings back without any U.S. tax. And 245 Cap A is similar. I think, and maybe, Jason, you and I can dialogue a little bit about this, but I would say the GILTI provision would be more impacted because there's a provision in the GILTI calculation that says if you are paying overseas 90% of the U.S. rate, you can make an election and you don't have to include those earnings currently. So what would happen if our rate went to 15% is that threshold will get even lower. It would be right around 12.5% if I'm doing the math in my head correctly. So I think that would be a provision that would be more impacted. And then the second thing is FDII would become less beneficial because you would just be getting less of it. You would be deducting against a lower rate. So I think both GILTI and FDII in the corporate setting would be more impacted by a rate deduction than, say, 965 or 245 Cap A.
Sure.
Yeah.
I'd agree with that. I think if the U.S.'s rate goes down, this 15% we're talking, I think a lot of the GILTI issues might go away, even for individuals, based on the high tax exclusion that Greg was referring to. So it definitely makes it a slightly different analysis again, as we talked about, to make sure, it's too early to model some of that out. But as we get more blocks in place of the new house, if you will, it might make sense to start doing some modeling to see what the impact may be, and at least to understand it. Maybe not to make changes right away, but at least understand it.
Yeah.
Right. So,
and I would say, Jerry, and Jason mentioned this, prior to TCJA, you could do some high-level planning on a single sheet of paper. Those days are long gone. And I wouldn't give anybody advice without having all the numbers on the U.S. side, the foreign side, all the moving pieces, and then running some numbers, modeling it.
Yeah. We're almost forced to model that now.
Yeah.
Yes, you are.
Yeah.
So, Jason, help me out a little bit there. I know Greg, if his math was correct, I didn't check him, but let's say it instead of 10%, it's now 12.5%. So, what are you comparing? And I don't want you to go into extreme amount of detail, but because we don't have that time. But so you're comparing that reduced rate or that affected rate in the U.S. against the rates in foreign jurisdictions?
Correct. And it's not the rate. So a key thing about the limitation Greg's talking about is it's actually the actual tax rate. So if you have a year where you don't pay tax for a loss, let's say it carries forward to the next year, even if you have income, you might not pay any tax, even if the rate is very high. Their statutory rate's very high. So it's really something to keep an eye on. So it's a comparison of the 90% of the U.S. rate compared to the actual cash tax effective rate in a country. And that applies for individuals too. It's all the same math. And that's some of the confusing parts is even if you're an individual that owns a CFC, you still compare to 90% of the corporate tax rate. So these are the nuances of the adds to the complexity and frankly, some of the misunderstanding that's out there on how it applies to certain fact situations.
And it's 13.5 for all of our OECD CPAs out there.
I'm glad you math checked that. Yeah. Very good. So it doesn't sound like if there's nothing done, we have a couple areas that will sunset, but it doesn't sound like anything's going to sunset and make these calculations simpler.
I would say no.
No.
My thought would be will there be another, as Greg used nuclear bomb that goes off? Will there be a completely different system again?
Right.
I don't think we know whether that may or may not happen. And then we have to react, obviously, to some of the groundswell of something like that to get people, including ourselves, educated on what that could look like, depending on what may come out or not.
I think the interesting thing for me and what I'm keeping a close eye on is the pay fors, because it's going to have to be it's going to have to balance over this 10-year period.
Yeah.
And so that's, to me, that's when you get all these crazy changes in areas nobody anticipated,
Right.
because they're trying to make this balance.
Yeah.
Yeah. Well, one thing I'm thinking about, guys, I mean, just seeing how important the end of 2017 was, and that reset, as I said, probably, perhaps, some taxpayers didn't catch that or didn't address it. Is it too late to do that?
No, it's not. And in fact, we still have situations where we have companies or more likely we find individuals that own foreign companies that didn't. I think by and large, the C corporation world probably was up to speed on that type of thing.
Okay.
But yeah, it's still required to catch up. Some of the provisions originally in 965 is you could pay the tax over 8 years. There were some other things. You can no longer do that, but you at least have to comply with the law and do those catch-ups. And then part of the reason for that is it's the law still applies under 965, so maybe your tax rate is still relatively low, and then you get this big previously taxed DNP earnings and profits amount that then you can plan with going forward. So it does have some benefit, even if you have to go back and go through what I'll call some pain to get everything complied with.
So it's a little bit of time value of money calculation on, there was a cost to repatriate and that trigger, that reset, but then you can bring income back and it's not taxed at a higher rate that's in play at the date, at the time you bring the cash back.
Yep, exactly.
Yeah. And the other thing I will say, just kind of circling back to the rate issue, is if the rates were to come down, right, to 15, and there was more persons who are able to avail themselves of the high tax exception in the corporate world, then you'd have a larger pool of earnings that you could repatriate under 245 Cap A, completely tax-free.
Okay.
So I think there would be two pieces to that. Then again, this is where the modeling comes in, and because anything that's not subject to GILTI in a current year goes into a pool that you could bring back and get a deduction for 100%.
So it's like a dividends received deduction.
Yeah.
essentially.
Okay.
And I think just maybe briefly, if we talk about the tax rates go the other way, then everything we're talking about is just the opposite. Less people have the high tax exclusion. What does that look like? How does the GILTI impact? So again, it's modeling. No matter which way it goes, it's analysis and modeling and figuring out what may benefit or detriment each particular fact pattern.
Yeah. Okay. Well, it seems like the major theme here is that you don't know until you model and you run calculations. It's not getting easier, and we'll have to wait and see which way rates go. If they do, in fact, move, they may not move.
Right.
But the calculations are going to change just because of some of these sunset provisions. But it sounds like they're kind of minor compared to some of the major U.S. tax TCJA sunset provisions that are going to happen in
that's true,
25 and some in 26. Yeah. Very good. Well, guys, I really appreciate you coming in today, and I always enjoy talking about tax and really love to talk about international tax. And I know that's where you guys' passion lies. So I appreciate that. And thank you both.
All right.
Thanks,
Thank
Jerry.
you. Appreciate it.
All right. Well, thank you for tuning in today. And I do want to thank Jason and Greg again for spending time with us, and appreciate you guys being here.
Thank you for taking time to tune in today. You can subscribe to Let's Talk Tax podcast on YouTube and follow us on Spotify or Apple Podcasts or wherever you listen. In addition, today's show notes and links to more about the episode can be found online at McGuireSponsor.com. We'll see you next week. Thanks, everyone.